Everything looked richer, yet somehow ordinary people quietly became poorer without immediately noticing the transformation everywhere. The economy never stopped growing, but something fundamental quietly changed beneath every familiar financial headline worldwide. That hidden shift transformed businesses from building products toward maximizing financial returns above everything else today. Economists call this financialization, yet the consequences reach far beyond complicated charts and trading screens everywhere. It quietly rewrote incentives, shaping corporations, governments, banks, workers, investors, and households across decades without headlines. Most people never noticed because the transition happened gradually, hidden behind prosperity, innovation, and rising markets everywhere. Yet today, almost every financial decision traces back toward this invisible transformation affecting modern economic life completely. To understand today's economy, we must first revisit a very different world from decades before financialization arrived. After World War II, businesses primarily earned profits by producing goods consumers actually wanted every single day. Factories expanded, workers received raises, and productivity often translated into steadily improving living standards for millions. Banks mainly connected savings with investment, financing factories, infrastructure, homes, and expanding local businesses through lending. Financial markets existed, but they generally supported productive economic activity instead of dominating national priorities everywhere. Then, inflation surged during the 1970s, shaking confidence throughout governments, businesses, investors, and ordinary households alike. Economic stagnation challenged traditional policies while rising unemployment climbed beside rising prices, confusing experts across developed economies simultaneously. Leaders searched desperately for new solutions promising stronger growth, lower inflation, and renewed investor confidence everywhere again. Financial markets gradually emerged as the preferred answer, offering flexibility, capital, innovation, and expanding global investment opportunities. Deregulation accelerated across industries, allowing financial institutions greater freedom to create increasingly sophisticated investment products rapidly worldwide. Capital moved faster than ever before, crossing borders almost instantly, seeking higher returns wherever opportunities appeared first. Money itself became increasingly profitable without directly producing anything tangible for ordinary consumers across countless industries today. That subtle change reshaped incentives more powerfully than almost anyone initially realized during those optimistic decades ahead. Corporate executives discovered investors rewarded quarterly earnings more enthusiastically than long-term productive investments across competitive markets everywhere. Share prices suddenly mattered almost as much as products, services, employees, or future innovation inside boardrooms worldwide. Executive compensation increasingly depended upon stock performance, fundamentally changing management priorities throughout global corporations almost overnight. Buybacks became fashionable because purchasing company shares often boosted prices faster than building additional manufacturing capacity instead. Research budgets sometimes shrank while financial engineering delivered faster rewards with fewer immediate operational risks involved. Investors applauded efficiency, although efficiency gradually acquired an entirely different meaning than productive economic progress had previously. Cutting jobs frequently impressed markets more than hiring talented workers capable of creating future competitive advantages instead. Debt transformed from occasional financing into a strategic corporate tool, maximizing shareholder returns through financial leverage repeatedly. Borrowing cheaply often appeared smarter than patiently expanding productive operations requiring uncertain long-term commitments from executives today. Financial ratios increasingly overshadowed craftsmanship, engineering excellence, customer loyalty, and durable industrial competitiveness across many sectors globally. Companies became partially valued as financial assets instead of productive organizations serving broader economic development anymore consistently. Wall Street's logic gradually influenced businesses previously focused almost entirely upon producing real goods and essential services. Manufacturing remained important, yet financial performance increasingly determined corporate survival within competitive capital markets worldwide today. Banks experienced dramatic transformation too, expanding beyond traditional lending into increasingly profitable financial market activities everywhere rapidly. Trading desks generated enormous revenues, sometimes surpassing profits earned through ordinary commercial banking operations during expansion periods. Complex derivatives promised sophisticated risk management while simultaneously creating entirely new forms of hidden financial exposure everywhere. Many instruments appeared brilliantly designed until stress exposed their unexpected weaknesses during volatile economic conditions unexpectedly worldwide. Financial complexity often impressed investors despite remaining poorly understood even among experienced professionals managing enormous institutional portfolios. Bigger profits encouraged greater confidence, while greater confidence encouraged even riskier financial experimentation across interconnected global institutions. Success reinforced itself because rising asset prices appeared validating regardless of underlying economic productivity actually improving sustainably. Housing gradually evolved beyond shelter into one of history's largest financial investment vehicles across developed economies everywhere. Rising property values encouraged families believing homes would reliably create wealth regardless of underlying economic fundamentals forever. Banks enthusiastically expanded mortgage lending because loans themselves became valuable, tradable financial products almost immediately afterwards worldwide. Mortgages bundled together transformed into securities purchased by investors seeking stable, predictable returns across global markets continuously. Risk seemed diversified, although genuine systemic risk quietly accumulated beneath impressive financial innovation and optimistic market narratives. Rising house prices reinforced confidence, encouraging additional borrowing throughout increasingly leveraged household balance sheets every single year. Consumption expanded because appreciating assets created psychological wealth without equivalent increases in productive national output actually occurring. Everything appeared sustainable until confidence suddenly disappeared during the global financial crisis with astonishing, breathtaking speed everywhere. Suddenly, complicated securities lost credibility while financial institutions questioned each other's solvency across interconnected global banking networks simultaneously. Liquidity vanished precisely when everyone desperately needed cash, exposing fragile financial structures beneath apparent prosperity almost instantly. Governments intervened because allowing complete collapse threatened ordinary workers far beyond financial industry participants, everywhere, immediately. Taxpayers indirectly stabilized institutions previously celebrated for sophisticated risk management and extraordinary market discipline before crisis struck. Ironically, many executives survived comfortably while millions lost jobs, homes, savings, and financial security during painful recoveries. Public trust weakened because rewards appeared private, while catastrophic losses ultimately became widely socialized across national economies together. Yet, surprisingly, financialization did not disappear after the crisis fundamentally exposed its deepest structural weaknesses to everyone. Instead, central banks introduced unprecedented monetary policies, stabilizing markets through historically low interest rates for extended periods. Cheap money supported recovery while simultaneously encouraging investors toward increasingly expensive financial assets worldwide once again enthusiastically. Asset prices recovered faster than wages, deepening wealth differences across societies despite improving economic statistics on paper. Those owning investments often prospered dramatically, while workers relying solely upon salaries experienced slower financial progress overall. Wealth increasingly depended upon owning appreciating assets rather than steadily earning income through productive employment alone anymore. Financial markets became central economic indicators despite imperfectly reflecting everyday experiences of ordinary households across entire nations together. Rising indexes frequently suggested prosperity while families quietly struggled with affordability, debt, and stagnant purchasing power simultaneously. This disconnect confused people because official optimism rarely matched personal financial reality inside countless ordinary households anymore. Economic growth increasingly relied upon consumption financed through borrowing instead of sustainably rising real incomes across economies together. Debt quietly substituted for stronger wage growth, masking structural weaknesses beneath expanding consumer spending over many decades. Governments also embraced financial markets, borrowing extensively while investors eagerly purchased sovereign debt across international capital markets. Low borrowing costs encouraged larger deficits whenever difficult political choices became inconvenient or economically painful to confront. Financial markets therefore influenced public policy almost as significantly as democratic elections across numerous advanced economies today. Credit ratings sometimes carried extraordinary influence over government decisions affecting millions of ordinary citizens every single year. Financial confidence became politically valuable because markets reacted immediately toward uncertainty surrounding fiscal credibility or instability. Technology accelerated everything further through algorithms executing trades within fractions of ordinary human reaction times every day. Capital flowed globally with astonishing speed, rewarding opportunities while punishing perceived weaknesses almost instantly across continents everywhere. Financialization merged seamlessly with globalization, amplifying both benefits and vulnerabilities throughout modern economic systems together. Success increasingly required attracting investment alongside producing genuinely useful products for customers around the world consistently. Businesses balanced shareholder expectations against operational realities, often prioritizing whichever delivered faster, measurable financial rewards first. Startups sometimes pursued valuations before profits because investment enthusiasm itself became economically valuable in competitive markets today. Venture capital encouraged ambitious innovation while occasionally rewarding unrealistic expectations detached from commercial sustainability entirely altogether. Financial narratives sometimes outperformed business fundamentals during periods of extraordinary investor optimism and abundant available capital. Speculation repeatedly blurred boundaries separating investing, gambling, entrepreneurship, and genuine long-term productive wealth creation efforts today. Social media accelerated market excitement, spreading financial stories faster than careful economic analysis ever realistically could. Individual investors gained unprecedented access while simultaneously facing unprecedented informational noise and emotional volatility every single day. Opportunities expanded dramatically, yet mistakes also traveled faster through interconnected digital financial ecosystems than before ever. Financialization therefore delivered undeniable benefits alongside uncomfortable unintended consequences affecting nearly everyone differently across modern economies today. It expanded access toward capital while increasing dependence upon financial market stability throughout society as a whole today. Innovation flourished, although speculation frequently flourished alongside genuine technological progress within competitive investment environments simultaneously worldwide. Wealth creation accelerated, but wealth concentration also intensified through appreciating financial assets owned disproportionately by fewer people. Productivity remained important, yet financial incentives increasingly determined where capital ultimately flowed across entire economic landscapes globally. The economy gradually resembled a balance sheet alongside functioning as a productive system creating tangible value together. Numbers mattered enormously because expectations themselves increasingly shaped economic outcomes through collective investor psychology every single day. Confidence became almost as valuable as factories, workers, infrastructure, innovation, and technological breakthroughs combined within markets today. Financialization changed incentives rather than replacing capitalism, making existing forces behave according to different priorities over decades collectively. Every participant adapted rationally inside incentives created through evolving financial structures and institutional expectations over generations collectively. That makes reversing financialization extraordinarily difficult because countless careers, investments, and policies now depend upon its continuation. Even critics frequently rely upon financial markets protecting pensions, savings, businesses, and retirement security throughout their lives. Escaping the system proves complicated when almost everyone participates, whether intentionally or unknowingly, every financial decision. The biggest question, therefore, isn't whether financialization exists, because its influence surrounds nearly every economic activity today. The deeper question asks whether finance still serves the real economy or increasingly serves itself instead today. History suggests incentives eventually reshape civilizations more profoundly than intentions, promises, or optimistic political speeches ever could. Perhaps the greatest economic revolution arrived quietly, hidden beneath rising markets, convenient credit, and comfortable everyday assumptions together. If finance keeps rewriting capitalism's rules, who ultimately controls tomorrow's economy and for whose lasting benefit?